We are back with another episode of the Do As I Say, Not As I Did podcast. And again, that name kind of describes everything that we're going to do today. We're going to give you advice based on the mistakes that we've made. So don't do what we did, do as we're going to tell you now because we've learned from the mistakes so you can as well. Each week I'm bringing on different very smart people to help you learn how to run a business in the right way. Whether that's founders or investors, experts of any kind really. And then together, we just answer the questions that you send through about the fires that are going on in your business and in your lives so you can work out how to move forward. So if you do have a question that you want us to workshop or debate or laugh about, send them through to podcast@joeldtrapani.com. Now I know that is one hell of a mouthful of an email, so check that out in the show notes if you want to learn how to spell that properly. I'm your host, Joel Trapani, and I'm the co-founder and co-CEO of Vigo, which is an edtech scale-up. We've scaled it through Australia and the UK, and now I'm in the promised land, the US, and that's our complete focus now. On top of that, I'm also an advisor and a coach in the product space where I help businesses and startups work out how to build great product teams so that they can actually build great products that people want to use. Because I did that the wrong way the first time, and now I know how to do it properly, and I want to kind of share that with other people. And today, I'm really excited to be joined by Zaz. Sorry, I'm going to say this about again because I already got it wrong.
It's okay.
I might not even edit this out.
I'll answer to anything. Most anything.
Today, I'm joined by Zaz Floreani, who is an early-stage operator turned investor, who is currently a partner at FirstMile Ventures and is the entrepreneur in residence at UT Austin, where she helps mold the next generation of innovators. She's a powerhouse in the Austin startup scene, known for her keen eye for potential and her commitment to nurturing new ideas. Outside of work, Zaz is a gourmet food enthusiast with a love for exploring Austin's dynamic food scene, which there is a lot of, and her insights into entrepreneurship and her knack for storytelling means she gives exceptionally good advice. Zaz is an expert at understanding the real value in early stage startups and then helping them to grow. So let's jump into it. Welcome, Zaz. Thank you so much for coming on today.
Thanks, Joel. You're way too complimentary. I don't know where you came up with all that, but that was great. I sound amazing when Joel introduces me.
You are amazing. And if you want to be introduced like that, hit me up at podcast@joeldtrapani.com and I'll write you a custom introduction.
I will. I just took notes. I'm just redoing my own elevator pitch now.
I love it. I'll send it to you after. Well, look, before we jump in, can you tell us a little bit more about FirstMile Ventures?
Yeah. FirstMile Ventures is a pre-seed seed fund based in Colorado and Texas. I'm the partner in Texas. My two partners are in Colorado. Our goal is to be the first check-in to category-defining companies in both those markets. So we're a generalist fund. We cover most industries that are related to the internet or software. There's plenty we don't do, like biotech or anything capital-intensive, but generalists in the sense of anything related to the internet. Partner only. So there are three partners. We're who you get. We can lead or follow on. So we're flexible, but our goal is to be in that first institutional round and really help that team get from, nothing to basically product market fit, which tends to be the moment you get your Series A, is like the milestone that would cap that. We strongly believe there's no playbook to get there. It takes a lot of creativity, a lot of testing and iterating. And we have, our team has a really diverse background, which we think can help you get there. So our founding partner, Bill, started a company, multiple companies, but one in the .com era, the real first boom, took it public. It grew 234% on the first day of trading. And then 3 years later, he shut it down. So he's seen it all from that seat. My other partner, Aaron, went to West Point, flew helicopters in the Iraq War, then decided he was done with that, and tech sounded pretty good to build a career in, and he's been in tech ever since. And then, as you mentioned, myself, I've been a startup operator turned investor a couple times now, but I think I'm on the investor side to stay. I'm married to an entrepreneur, so we've got enough of the chaos in our house for us right now.
Wow, that is very cool. What a crazy mix of partners, like the Iraq War, .com boom, and then your own building experience and continual kind of flip-flopping between those two phases. That is so interesting. But being the first check-in is your kind of remit. That I'm a founder, and that makes me nervous. Like the idea of investing first just seems there's not that many investment firms out there that have that as a focus.
Yeah, I mean, it's our focus. We have come in after someone did a pre-seed or a friends and family round, but that first institutional round tends to be the hardest to raise because most people have nothing at that point. It is the riskiest. And so, from a venture perspective, that's why you take significant amounts of ownership. But it also has the highest upside of all the points of entry into a startup's life.
Yeah, that's where you see the 1,000x returns.
Yeah. I don't think we're going to see those for a while, unfortunately. But yeah, we're hoping to get one of those or two.
I love it. Well, look, let's jump into the questions today. Interrupting today's conversation because I'm back to tell you even more about our sponsor. This podcast, your favorite podcast in the world, is officially partnered with Miro. M-I-R-O, Miro. That's just because I talk really quickly. I know that you already know what it is. Look, at a first glance, it might seem just like a simple digital whiteboard, but Miro's capabilities run so much deeper than that. It's a visual collaboration tool where the whole team can build on each other's ideas and just create something innovative, different, something for you together from anywhere in the world. And this week, I want to tell you about some numbers that I just learned about Miro. First of all, Miro helps you deliver projects 29% faster. That is so crazy it seems made up. But they did the math, and on average, projects are delivered 29% faster, nearly a third faster by using Miro and bringing all that collaboration into one place. Just imagine how many extra engineers you could hire on your product team if you were making that many savings elsewhere. This one's even crazier to me though. The average Miro user saves 80 hours per year by using the platform to streamline their conversations and feedback. That's 2 complete work weeks. Well, maybe 1 complete work week for a founder, but that's still a lot of time saved just by using this. And this is all because Miro lets you bring everything you're doing into one place. It means you can have everyone on your team, they can plan, research, brainstorm, design, everything they need on their own time from anywhere in the world. With Miro, your project doesn't need to stop just because someone's workday does. And today, if you sign up, you get your first 3 Miro boards free forever. So sign up today at miro.com/podcast. I'm going to put that one in the show notes, but just again, real quick, miro.com/podcast. All right, let's jump back into the questions today. Question number 1 is called, how much should I pay myself? I've been in the conceptualization, planning work, and market research stage for a very long time. Within the next few months, we will be ready to finally execute and start building something. There is a VC who has said they're willing to invest seed funds into the business and messaged me today asking me to prepare a rough financial budget for the costs of running both pre and post revenue. He said I have to include things such as legal fees, admin fees, website, some marketing, and a basic salary. I have no idea what to come up with for the salary. The other stuff is relatively easy to research. However, I'm clueless as to how much a basic salary might be. He hasn't said how much he's willing to invest exactly, and I'm guessing it's because he wants to see what kind of provisional budget I send over. Is this normal? Is this... how much is seed usually anyway? How much should I say I'm looking for? I don't know what kind of sum to suggest for salary because I don't know what he is able to invest, and I don't know how much he's willing to invest. I could ask him, but I don't know if it's the proper thing to do. This one's from OKBike239. That is a really stressful place to be. I remember that when we were really early and we were in an idea phase and someone said, I'll invest, which was bullshit at the time. But anyways, we just started panicking like, how much do we need? 10 grand? $1 million? Like I've just got no idea. It's scary.
It's scary, and it really varies depending on industry, kind of your costs, right? So it's sort of hard to tell from that intro, but idea conception, right? They don't have an MVP.
Yeah.
Sort of how you'd summarize the stage, right?
Yeah.
I think you'd want to start building the model bottoms up. So all kind of known costs, if you know them. And if you don't, you got to go research them. It's funny, I had a call with a founder called me yesterday who were talking to investing in their pre-seed round. they came up with the number of $500,000, but they don't have a model. So we said, all right, send us your model, kind of like this situation.
Yeah.
And they're in the conception phase. And this one founder whose background's in banking is like, the model's not going to be as pretty as ones I don't, you know, he was like trying to gauge manage my expectations. And my point to him was, hey, Riley, like, what you really need to do is just go through this exercise yourself, because you don't know. He actually said it. He said, yeah, we didn't know how much the costs were going to be. They're using some of the big LLMs, and it's going to cost more than they anticipated every time they make a call. And so they need to know that because it affects their pricing. But so I'd start bottoms up. And then, you know, when you get to the salary line, like that's the last thing you add in. You bottoms up, assuming, you know, whatever assumptions you have around if you can even price for your betas or not, you know, what your burn rate's going to be. And depending on how much you're burning, you can fit yourself in or not, right? Because there's always a sacrifice you're going to make if you spend $60K on a salary for yourself. What are you not spending that on?
Yeah.
What were you told? Were you told you needed a salary at the beginning?
It's kind of challenging, to be honest. So I think, first of all, there's just so much to unpack in this question. And you know, the challenge with reading is that there's so many follow-up questions that we'd like to ask, but we just have to make some guesses with the information we have. But from my own personal experience, I have an immediate red flag with an investor saying they're willing to invest if you're still in the conceptualization stage. Like, if you've not built anything and you're not, and you are a first-time founder, like you're very much in the idea phase. Like, you don't have anything yet. Your idea is not novel, really. Like, until you actually execute some element of this and get some proof points, like, I don't think an investor's going to back this. So I think you might be... What if
they said, well, I was employee number 2 at Superhuman?
I just think if you're employee number 2 at Superhuman, then a lot of these... I don't think they would have the same kind of questions. Like, I think they would have like a network which they would know all of this kind of stuff.
Yeah.
Like, so my guess, and I'm just, again, we have to make some assumptions here. So my assumptions are, you're pretty new, and this is the phase I was in. I was asking these same kind of questions. I was asking for investment for an idea. And the chances that someone actually invests and is genuine in this stage, I think is very low, because your proof points are so low. Like, you're not that investable right now, which is okay. You just need to put more time into it. Like, it's cool that you're doing this. It sounds like you got a good idea. And the fact that investors already kind of interested is a good sign. But I would just, I'll take it with a grain of salt, first of all. Maybe they're genuine. I think the chances of you actually getting a meaningful check at that stage is pretty low, unless they're a non-sophisticated investor. Because non-sophisticated investors, they kind of don't know either. And they're just like, cool, let's have a crack. Like, inexperienced investors. That's my first kind of gut feel on this. The second is like you said, Zaz, go bottom up. That makes complete sense. You can work everything else out. How much is it going to cost you for every call you make? How much is it going to cost you for the accounting fees? You can figure all that kind of stuff out. Even if you guess and then, add some fat to it, that's good. How hard is it going to be to build? How long until you can commercialize, etc. That's all. You can work that stuff out. Salary is weird though. And in my own experience, we quit our job and we took $30,000 salaries. And that was in Australia. But, I was in a really fortunate situation. I had a wife that was supportive and could allow for that. But we just couldn't have quit otherwise. We only had $60,000 of investment and we had to support all of us. So like we just went 60K, 30K. So we just went to the bare minimum we could survive off, like what could we do to pay our mortgages and what other part-time jobs could we get to kind of supplement that. So it's kind of situationally dependent. But what I would say is non-situationally dependent is that if you are a non-proven founder in the early stages, you cannot justify a decent salary. Like it has to be a sacrifice and you have to be in pain or investors won't chip in. Because that's my opinion from the founder side, the operator side. But I'd love to know your thoughts there. So I was like, my guess is that you wouldn't just be like, get comfortable, guys. Have a nice salary.
No. Yeah, I think so. Two things. I said my husband's an entrepreneur. I was the breadwinner for the beginning of our relationship. They didn't pay themselves a salary until they had revenue coming in and could, and they paid their employees first, and then the founders paid themselves. And they bootstrapped. And then when they finally took on venture funding, even then, the salary they took was still sub-market. So I would never suggest coming in with a market salary of like, well, I'm the CTO and CTOs typically make this at a seed stage startup. That's not what an investor would get interested in, because you're part of your whole take is your equity. And so as a founder, that's a huge part of your compensation. So we typically suggest, it's typically a conversation, to be honest, to understand what are your bare needs. Are you married? Do you have kids? Like, that complicates things versus, the fortunate situation of being single and having some savings and can live kind of off ramen for a while, like people used to. But yeah, a red flag would be someone paying themselves over 90K or 80K at the beginning without anything built. To your point, right? Because it's so cheap to get something built today. Between incentives you can get from all the costs from hosting down to dev, unless you're not a technical founder, it doesn't cost that much to get something off the ground like it used to.
Yeah. Okay, so I guess we'll bring this one to a close. And so our final judgment here is be cautious of this investor. Just don't waste too much time on it. Give them the information they need, but don't really, go too hard. But this activity is a useful thing for you to do because you should understand how much it's going to cost to run your business, so you can start to aim towards it as you start to grow it yourself. Then you're going to have to take a sacrifice in your salary, and it's going to be a non-market salary. 80, 90K is going to be a flag. So it should be much lower than that, but it should be what you can justify, like you should be living without like severe pain, but you shouldn't be living a luxe life at all, but that is very much personally dependent on if you have kids, if you have a mortgage, if you're single, if you're living at home, all those things should come into it. And you just got to remember that every dollar you pay yourself, you can't pay someone else to do something else as well. So it just becomes down to, what's going to get your start to commercialization as fast as possible.
Yeah.
Great.
That's good.
All right. Okay, Bike 239 has been advised. Zaz, we're trying to work out, what our tagline is when we give someone advice. So if you've got any pitches, we've had amen at the end of a question, we've had hoorah, and you've been advised. If you've got any good ones, we can throw into the next one. Okay. All right. Next question is called turning down money. Is there a downside to taking 500K of investment in a seed round from an angel investor? I have a deep tech startup and we have an upcoming seed round of $2.5 million, and an angel wants to put in 500K. I like the investor, but I don't know if there is any potential downsides. This is what comes to mind, but I'm looking for your thoughts. Deep tech VCs may only want to see investors who can do proper due diligence. Or this single individual might hold too much power. If this is the case, how can it be mitigated? Or VCs only want co-investors who can also commit into future rounds. I'm just not sure if this is a good idea or not. Any other thoughts from Amplifier 101?
Amplifier 101, all right. There's a lot of questions there. These are like multi-question questions. I think we need to pare them back a little more. So deep tech company raising, what did he say, 2.5?
2.5, yeah.
2.5 has a potential angel who wants to do a fifth of that.
Yeah.
And he's worried that's going to signal to other investors something negative or to the market.
We're just not sure what it means. Like, is it a bad signal, or will they end up with too much control, or they're not sure? Like, they just want to know what should they be aware of, and is it just, fundamentally a bad idea?
Yeah. Well, so first off, on the control question, you're raising an equity. You're selling a minority position, so no one should have too much control after this round. If they do,
Yeah.
then you didn't get a good lawyer. So, backup number one: hire a really good lawyer who does venture and who does startups, and not your cousin's friend who can do it for you really cheap. That's not how you do it. If you're worried about things like control, because
Yeah.
you know, and it's worth it to pay because the wording, the terms that get set don't necessarily hurt you in that round. They hurt you in 2 or 3 rounds down when things go wrong. It's really the downside protection that you're trying to put in there for things like change of control. So I think if you're looking to raise 2.5 and any investor has offered to do a fifth of that and you haven't filled out the rest, it's a pretty good commitment to say in future fundraising meetings, hey, I've got a fifth of my round already committed. Again, without real context here, it's kind of hard to give a good answer. It doesn't sound like they have a lead investor, but showing momentum and showing other interest is important. Angels typically don't lead rounds, so a check of this size is large for an angel in my experience, or in the markets I work in. So I would say yes to it as long as doesn't come with special terms or any kind of favoritism.
Yeah. Yeah, I think definitely get a good lawyer, because that can hurt you pretty badly down in the future, and you're just going to have to pay with a lot of money and a lot of time to get it fixed otherwise, if you even can. But I see no problems with taking a decent check from an angel. At the end of the day, especially at the moment, like, cash isn't flying around like it used to. It's harder and harder all the time to raise seed rounds, like, especially like you mentioned, Zaz, like those early rounds are the most difficult. So I know there is a lot of conventional advice out there that says be careful and choose your investors. I think that is very true if you have a lot of investors to choose from. But I do think the vast majority of startups actually don't have that luxury, and it's all about, I'm choosing this investor because they said they'll give me money, and that's real, and that's actually okay.
Yeah, I think maybe that advice there should be a footnote of, know the most about the investor as you take their money, right?
Yeah.
Because you might not have as many choices, but be eyes wide open when you say yes to anyone.
Yeah. Yeah, so I think, take that money, but also you don't need to commit immediately. When you do a round, it's going to be like a timed thing. You're not just going to have this person chip in and then 2 months later someone else chips in. Like, you're going to pull your round together all in one moment. So when that round comes to it, you can actually make a better decision too. In all of your other conversations, say, you've already got a fifth committed, or now you've got 40% committed. Like, keep having these conversations with investors. And if it turns out you've got other investors that can bring a whole lot more value to it, either oversubscribe the round or then cut this investor out. But you don't necessarily need to make the call, in my opinion, so yes or no right now. Just be like, that's really excited. Let's keep talking about it. And when we do our seed round, like, let's have that conversation and keep building the relationship there. And then if you have the option, make the call at that point.
Well, I think normally, too, you want a lead investor to set the terms, not an angel. I always find it odd when I'm talking to a seed company or seed stage or pre-seed that's already set terms with their angels, the friends and family who say they want to participate. And yet they haven't, the round is only like 25% filled out or something, right? And so they're looking to fill the majority of it with one other party or 2 other funds, yet they've already decided here's how we value ourselves. Yeah. So I think to your point, I'd say we'd love to have you on the cap table. Let us secure a lead investor, and if you're comfortable with those terms, we'd love to have you in the round. Yeah,
absolutely. But also, congrats on getting someone willing to put $500K in. That is huge, and it is especially huge at the moment. 2023 is a weird one for fundraising.
Yeah, that's true.
All right. Well, I feel like Amplifier 101 has been well advised. My only additional advice actually maybe would be read Fundraising by Ryan Breslow. It is the only book that matters when it comes to fundraising. It's exceptionally good. It's 50 pages long. I talk about it a lot. He tells you how to run the process start to finish, and he will tell you more specifically how to deal with this situation as well, about how to keep that lead warm as you fill out the rest of your round. So yeah, always read that book. If you're interested in fundraising, read it.
I'd add Joel. Have you read Venture Deals by Brad?
Yeah, that's also a really good book. Like that's a book that just helps you understand the words in venture. Venture is actually like a very complex language. So understanding in more detail what downside protection actually means and what it looks like and what preference means. When I first read that, I was like, oh gosh, I've been talking in a pretty dumb way until now. So that is actually a very good book.
I think it's the other thing that I think it would help drill into anyone's head it drilled into my own head, and I've been, an investor and led teams at startups, is that when you're on the other side of the table, the non-investing side, you're only going to go through this a handful of times, like max count on one hand, two if you're lucky, right? In terms of fundraising and signing docs. And so you want a lawyer who's done it 1,000 times every year, right? And I've had multiple conversations with founders about this, especially when I was at UT as an EIR, where a founder got a term sheet and he showed it to his buddies, but he didn't show it to his lawyer. He's like, I showed it to my friend who just went through YC. And they said it's an unconventional safe. And I was like, hey, I'm not a lawyer. I'm not going to tell you what's in it. You talk to your lawyer and you listen to your lawyer. Because if you have a good one, they've seen thousands of these. Not your buddy at YC who's seen them maybe one or two or three, because they're just not going to have the same perspective, and they're not going to be able to help you avoid the things that you're going to wish you'd avoided 3 years from now. 5 years
and you can also get like good lawyers for not that expensive, like in those earlier stages as well. Like a lot of lawyers, especially in that seed stage, will give you big discounts because they're banking on you getting to those later stages as well. So start those relationships early. Get a good lawyer who is specifically experienced in this space. Not all lawyers are good. A divorce lawyer has no idea.
Every big firm has teams that handle tech typically these days, and they'll have capped fees, and they'll typically do like a safe for under 15K and an equity deal for under 30. So great. Get a good lawyer. Getting back to that.
Yeah. All right, Amplify 101. Get a lawyer. That's the end of this. You've been advised. All right. So we're moving on to the last question for today. This one is called My Co-Founder Left.
Ooh.
So it's not starting strong.
I don't mean to laugh. This is not fun.
No. So I'm building a high-tech company, and my technical co-founder decided to leave the journey to grab a high-paying job he got offered in another country. He genuinely believes in the product, but he realized what he wants is a nice, stable life. The problem is we were both supposed to go to a meeting with an A-list investor in 3 days. I plan on still going and saying very honestly what happened, and tell them I don't believe the meeting will be a waste of their time, which is why I didn't cancel. What do you guys think? Cancel or go and make the best of it? From Competitive Ad 1591.
Competitive Ad?
Yeah. Competitive Ad. I don't know. I love the names.
Yeah.
This is tough.
Crummy situation to be in.
Yeah.
But at least you found it out before you took money and got that institutional investor on your cap table. Because that's a lot harder conversation to tell your new investor your co-founder left. I don't think it's helpful to this person to talk about how you could have avoided this. Sometimes people will say they're willing to do anything, run through walls, and then the second adversity hits them, they're like, I kind of like that job at Meta. So I won't go there. That sucks. What do you do? Do you take the meeting or do you not take the meeting?
I think you got to take it, to be honest. So a similar-ish thing happened to us. Yeah.
Like, what are you going to do? Cancel it and then try and find a co-founder in 2 or 3 weeks and then reschedule?
Yeah. At the end of the day, I think the number one thing here is transparency. Like, you really do build a relationship with your investors over time. So if you start by lying to them, that's bad. That's not to say I don't think you should cancel it. I think you can go to the meeting, but you just need to be upfront in the meeting. If I was in that situation, so all the way back before we took our first money, we had a pretty similar situation with us where, early days, one of our co-founders liked to quit all the time. He's never quit. He's still here. We love him. But he used to quit all the time. And this one time we really thought he was quitting. and we, just before we got into this accelerator and was about to take $60,000, it was like this huge moment. He just quit. And we're just like, oh no. And from that point, what we did is we went in, we organized a specific meeting with this accelerator, and we said, this has happened to us. Like, we don't want to mislead you. We want everything to be above board. And here's how we're planning on mitigating this. And so we just thought about what had to happen to mitigate it. But we also want your support on this. Like, is there anything you can support us in this space as well? So I would take the meeting. I would keep the majority of the meeting still up about the opportunity that's in front of you. I would raise this as a risk, but raise it that you have a mitigation in place. That you'd like support as well. But it doesn't sound like he
has a mitigation in place.
But you've got 3 days. Spend the 3 days coming up with that mitigation. Like, come up with a plan. So it doesn't have to be perfect, but to have something. Show them that you're not just like they're drowning, because then it's fully done.
Yeah. Well, the non-secret secret about talking to venture funds is just getting to the next meeting, right? And so I think if you cancel this, there's a risk you won't get another one scheduled, even if you find a co-founder by that time or a technical lead to fill this hole. So I agree. I think you take the meeting. Often in early meetings, it's just the CEO. The technical person's not there. I think you take their name off the slide and you share, I had a co-founder who had a bit of a life crisis and realized startup life wasn't for him. And I have, to your point, 2 or 3 backup plans on how I'm filling it. But honestly, it happened days ago and we're working through that. The core idea hasn't changed. It's just finding that exceptional person to help you build it. I think you take the meeting.
Yeah.
And you maybe say you're not raising. You tone down that I'm not ready to raise till I have this other teammate.
That's actually not a bad idea.
Just keep it more as an information.
Or until I have a technical lead. Yeah. But like you said, get that meeting and get the next one. So I'd like to catch up in another 2 weeks. And I'll actually be able to give you a much bigger update on what's happened here. This has just happened, but so I'm gonna go heads down on this for the next couple of weeks, and I'll come back to you and let you know where we land.
Yeah, I think that's good.
Okay, I like that. All right, so final judgment is definitely take the meeting. Don't try and hide it. Just be honest and lay off the intensity a little bit and make it very clear that you're doing everything you can and you have a good idea about how you're going to fix this.
Yeah, just don't come across as desperate or panicked, which you shouldn't be.
Definitely don't come across as panicked.
It's like a blessing this person left you.
Yeah. Yeah, you can probably get all that equity back now too. So that's good. Opposed to having to wait.
Yeah.
Yeah, so that's another thing. Fight for that equity back now.
There. Get the equity back.
Yeah.
Nice troll.
Great. All right. Well, look, that's all the time we have questions for. So we're going to jump into our last section of the show, which is plugs. This is the absolute best part of the show. I love hearing what people have to plug. So what have you got going on right now, Zaz?
I got FirstMile, so I'm plugging my fund. You can shoot me a deal, or if you're interested in investing in the fund, at Zaz at FirstMileVC.com. We're actively investing in Colorado and Texas-based startups at the pre-seed and seed stage.
Great. And I'll put that email and a link to the website in the description as well, so you can find out more. But look, you don't hear a lot of investors saying, send me deals. So send the deals through. Zaz is awesome. All right. And on my side, don't forget to like and subscribe. Get your phone out right now. Hit subscribe on your favorite platform. Give us 5 stars. And then I will say this for every episode forever. Pull out your friends' phones, your parents' phones, your family's phones, and like and subscribe on their phones as well. You know, we love that. And then thank you to everyone who writes in. We love these problems and questions, and hopefully we're able to help. So if you have a question, if you have a fire, send it through to us. Send it through to podcast@joldytrapani.com. And lastly, I love talking about this kind of stuff. So if you want to talk, book some time with me. Tell me what's going on in your startup, what product problems in particular you're having, what kind of team management problems you're having. Let's have a conversation about it. I love jumping on a video call and working out what's going on in your life too. So we're going to wrap this one up. Zaz, thank you so much for coming on today. Thank you for arguing and laughing with us. This is a really fun conversation.
It's been great. Enjoyed it.
This has been another episode of the Do As I Say, Not As I Did podcast. We'll see you all next week.